Hello, and welcome to the Long-Term Investing Podcast with Baskin Wealth Management. I'm Barry Schwartz, Chief Investment Officer. Baskin Wealth Management is an independently owned investment management firm with over $2 billion in assets under management, providing customized wealth management solutions and services to families and foundations. In this podcast, we ignore all the noise and have conversations that make sense about the things that matter in today's markets. It's what we talk about with each other here in the office, and we want to share those conversations with you. Please stay tuned for our legal disclaimer at the end of the episode. It's January 15th. Thanks for joining us on the Long-Term Investing Podcast. Ernest, how you doing today?
As good as ever.
Awesome. I'm doing well too. You're feeling okay? Markets, it's funny, people call, when the markets go down, they call them volatile, right? If it goes in your direction, it's not volatile, of course.
No, that's exactly right.
Yeah. So we've seen a little bit of a pullback in the markets since, I guess, the height of November, the frenzy of the election of Donald Trump. It's funny. So when the market goes up because Trump wins, people say Trump's good for the markets. Of course, when it pulls back, well, Trump's not going to be good for the markets. This is just normal price equals narrative, so to speak. So we're going to touch on a number of topics today. We're going to talk about volatility. We're going to talk, a client reached out to us and asked us about Goldman Sachs predicting that the stock market's going to only make you 3% a year.
Yep, for the next 10 years.
For the next 10 years. So we want to discuss that article, that paper. And our feature discussion is about Canadian energy and Canadian infrastructure. Ernest attended a conference, a well-attended conference, and by many Canadian energy companies, and he'll give his insights about that conference. So as always, we always appreciate your comments and your feedback. And if you like this podcast, please follow us on YouTube, on Spotify, on Apple. And of course, if you're so willing, a 5-star review would be great. Please tell your friends, tell your enemies, tell them to listen to this podcast. There's nothing better than talking about investing. It's my favorite thing in the world, aside from golf. So Ernest, getting back to the market volatility that started, as we call it, the market pullback. And of course, today, the U.S. inflation number, very cool. Coming in much lower than expectations. So the market is rallying. Pretty much what we've been seeing over the last few months is interest rates in the U.S. have ticked up. A, because worries that Trump's actions could be inflationary. B, more importantly, is that the U.S. economy is just doing great. Strong jobs numbers, good manufacturing numbers, good services number, good earnings, and I guess the biggest reason is the Fed is pretty much signaling that they're going to slow their rate cuts or maybe even pause rate cuts going forward. So as a result, interest rates have gone up. Of course, the U.S. inflation number today, much lower than expected. Maybe the Fed will start cutting again. These kind of things are, in my mind, a complete waste of time for us to try and, great talking points, but complete waste of time to try and figure out how the markets are going to react to these things. And you shouldn't react either. It does not change our approach to long-term investing. In fact, it may make the stocks that we want to buy for you even much more attractive or provide opportunities to buy new positions in our portfolio. So we like market volatilities. We like market pullbacks. I know it's painful. I know it sucks when you're at your all-time high and a week later you're much lower. So don't look at it every day is probably my advice. Any color to add on that?
Well, a lot of the companies that we own buy back a lot of stock. Mm-hmm. And so to the extent that they're able to now buy back stock at a cheaper price, I think that's a good thing for the long term of these companies.
That's right. If you're going to be a holder of great businesses, you want them to buy back the shares that you own or the shares of that company at a lower price, not at a higher price. That adds intrinsic value to the share price, and it's a great thing. So anyways, that's the business of stock markets. Our whole job, why we exist, is we're trying to get our clients better rates of return than if they left it in a risk-free product.
Right.
That's what we're here for. And so to achieve, if you want to make more than 4 or 5 or 3% risk-free before taxes, you have to take on risk. And that inevitably leads to volatility. But we're hopeful over the long term, given the results that we've done for our clients over 25 plus years, that will continue to outperform had you left it in the bank and done nothing. So speaking of volatility, speaking of predicting what the markets are going to do, Goldman Sachs is so bold as to predict that the stock market over the next 10 years is going to underperform. So let's go through the paper. You read it in detail, and we'll break it down.
Goldman came out with a well-publicized forecast that over the next 10 years, the S&P 500 is going to earn 3% on a nominal basis,
Yes.
and 1% on a real basis.
So they're predicting inflation will be 2%, and the stock markets are going to do 1% a year.
Right.
Ooh, that sucks.
Yep. And the way that they came to this conclusion was that they created a model based on 5 factors, which are, valuation, economic fundamentals, interest rates, market concentration, and profitability.
Okay.
And then they, threw it into a black box and did like a regression.
Yeah.
And basically it spit out that it's going to be 3% per year.
Yeah.
And the main driver of the argument, they broke it down a little bit more than that, is that number one, valuations are expensive, which is not really
on an absolute basis. No one can argue that.
Yeah, it's not a controversial thing to say.
Yeah.
Another thing that they've said, and another part of the argument, is that market concentration is at a record level.
No arguments there.
So what this means is that the bulk of the value is concentrated in the top handful of stocks.
For those that don't know, 10 stocks represent about 40% of the market capitalization of the S&P 500. Those 10 stocks are the Magnificent Seven, Berkshire Hathaway, Broadcom, and I'm missing one. Tesla. Anyways, it doesn't matter.
Yeah, it doesn't. Anyways.
It's hard to do this off the cuff, but there's 10 stocks that represent 40%.
And so historically, what they did was that historically, if you look at times when market concentration was at a high, what usually happens is that due to antitrust and due to just competition in general, is that profit margins at these companies tend to slow and growth slows down as well.
It's hard to argue that as well. I mean, all these large companies everyone is facing some type of antitrust lawsuit, huge regulations in Europe. I mean, Europe drives me crazy, but that's a podcast for another day. Mm-hmm.
And so that's how they reached their conclusion, which then compares that to what interest rates are today, and says, they think that bonds are more attractive than stocks.
Yeah. And once again, hard to argue. I can't say whether bonds are more attractive than stocks, but I can say that starting interest rates today in the U.S. are the highest they've been in a long time, right? So it does offer a competing alternatives to putting your money in the stock market.
Yep. So when I read these kinds of reports, they always sound very reasonable.
Yeah.
And you read it and it's like, wow, well, actually I might earn 3% over the next decade. But then if you actually take a step back and think about it, then it all kind of not falls apart, but then you realize that it's not quite so easy to predict the future.
So many bearish or doom and gloom arguments, when you think about them, make sense.
Yep.
Right? Oh, we're swimming in so much debt. The deficits are out of control. Okay, sure. There's so much uncertainty in the world. No arguments. You can't argue any of those points. The only argument you can say is none of this is new news.
Right.
And none of this has hampered market performance over the long term. Right? So if you look at history, corporate profits tend to grow at GDP type levels, right? 3 to 4%. You tend to get inflation, which can lead to pricing power. You can tend to get companies can get increases from productivity over and above GDP. dividends, share buybacks, you get decent returns. And that's what the market has done through crazy times of volatility and crazy times of uncertainty.
And
I'd be curious to know what Goldman Sachs thought of the last 10 years ago. Did they say that, did they know exactly that the market was going to go up 13% compound?
no, they said they actually talked about this,
Yeah,
and they said they expected about 7%.
Yeah.
So they admitted that it was under their original forecast was significantly under what ended up happening. But I think broadly my problem with these kinds of forecasts is that they're not really looking into what's actually going on within these companies that are comprising of the index.
Okay.
Right?
No one does. Everybody can quote price and PE and market levels without telling me what's under the hood, right?
Right.
Yeah.
And so, sure, you can disagree about, you can think that Nvidia or Microsoft or Tesla or Apple are overvalued, and like you can like look at the demand for their products, look at competition and all those kinds of things, and say, yes, I think that Nvidia stock is overvalued and I don't want to own it.
Yeah.
But that's why we don't own the index. That's why we pick the stocks that we think are attractively valued within there, and try not to own everything just because that's what the index tells you to own.
That's right.
And I think even beyond that is that I think broadly speaking, the one thing that the market has missed for the last say 15 years or so is how different the current generation of tech companies are versus the past, right? If you think about like the IBM of back in the day, or Bell, right? Like these were still fundamentally like American focused, like manufacturing companies, right? Whereas
There was no software involved in the IBM. It was selling hardware.
yes,
Yeah.
right?
Xerox was selling Xerox machines.
Right.
Yeah.
Whereas the companies that are the tech companies today, like Google and Apple and Microsoft and Meta and Tesla and Tesla, you can quibble about, but these are extremely profitable. These are global companies that, in my opinion, are just not trading at very expensive valuations relative to the growth that they have. And I think the markets overall have missed the fact at how dominant these companies are, and how they just continue to gobble up market share in the areas that they work in.
Yeah. No, you laid it out perfectly. And we talked about this on our previous podcast last week, Take Me to the Stars, about Constellation Software. We talked about compounders. We talked about how what may look expensive in the short term may actually end up being cheap. We happen to believe that a lot of the companies that we own are growing at faster rates than the S&P 500, offer better balance sheets, offer better business models. It is, on an absolute basis, it's hard to argue that the next 10 years is going to be as good as the last 10 years. If you believe in mean reversion, right? If you believe that, okay, so the last 5 years, the S&P 500 has done 13 or 14% compound. The historical rates of return are 9.5% for the S&P 500. It's easy to figure out that we could perform going forward, or not. That's the beauty of the markets. It's all going to depend on the earnings per share growth, what companies are going to enter into new areas, have new tailwinds that are tremendous, and you and I, we don't want to own an index. We prefer buying individual stocks.
Right. So, and I mean, we're kind of repeating the same thing here, but I mean, you look at a company like Meta, which is, it's a great company that generates a lot of free cash flow, and it trades at like something like 22, 23 times earnings, which, I mean, yeah, they're spending a lot on CapEx due to AI, but that doesn't scream expensive to me.
But it's 23 times earnings on 2025, and maybe 20 times earnings on 2026, and maybe 18 times earnings on 2027, and maybe 10 times earnings on 2029.
So I just struggle to see how the math can work such that you're only earning 3% for a company like that. So
Yeah, so we try here at Baskin not to listen to what economists have to predict about what's going to happen in the short term in the stock market. They can be either right or wrong. What strategists have to say, we do our own research, we do our own homework. We don't lay out expectations for clients that they're going to compound their portfolios at 15% a year. We give realistic expectations. Our hope is that we can beat over the long term, the Toronto Stock Index, the S&P 500 Index, but doing it in a very conservative fashion, not overweighting any stock or sector. And I hope that appeals to our clients and prospective clients. That's just how we do things. If we underperform the S&P 500 in 1 year or beat the TSX in the next year, that may be an interesting talking point, but it's not something that is going to keep us awake at night. Our goal is to protect our clients' money and grow it in a fiduciary way that we feel is going to protect and preserve their capital over the long term. So, there's lots of people that predict markets and they're absolutely wrong. Jeremy Grantham of GMO, he told you the U.S. stocks were completely overvalued for 20 years and that he's been completely wrong. Maybe he'll have his day in the sun. Maybe Goldman Sachs will be right with this. That doesn't mean our clients are going to earn 3% nominal, 1% real. Hopefully we can outperform that.
Yeah, so
if that turns out to be true.
I think there's a couple of things that I want to add on to that. Is
Please.
That I think historically, the report itself acknowledges that the probability of 3% nominal return is extremely low and generally only occurs at market crashes.
Okay.
Right? So
there has to be something really horrible that happens.
Right. So if you started at like 2000 and you ended in like 2010, which is like, so at the top of the internet bubble to like the bottom of the financial crisis, then you would have earned like a terrible return.
That was a terrible 10-year period, right? You had the internet bust, complete disaster. Then you had 9/11. Then you had the financial crisis that like people were scared to even leave their money in the banks. So uncertain.
But then in those cases, you're not so much making a judgment about what the valuation is like and all those things.
Yeah.
You're basically predicting market crashes,
Yes.
which is something that I don't think anybody can predict with any regularity, and it's not something that you can do about anyways.
There will be people that will say, AI is in a bubble, and now it's quantum computing, and then soon it's Bitcoin also, and
all right, you're not adding fart coins to your portfolio?
Fart coin. Like there's just all these things that are in a bubble. There's always going to be something in a bubble. There's always going to be something that you don't understand as an investor. Guess what? You don't have to participate in it if you don't understand it. So I think we've beaten this horse to death enough. So
we'll just end with Buffett's famous quote.
Let's hear it.
If studying history was all there is to the markets, then the richest people in the world would be librarians.
So.
And I don't know. I don't think librarians.
Well, they may have a wealth of knowledge, but they don't necessarily have the hedge fund wealth of Bill Ackman.
Maybe that's worth more.
Maybe, absolutely. So our feature discussion today is about Ernest's attendance at the ATB Conference. ATB stands for?
Actually, don't know.
Yeah, I think it's the Alberta Treasury Board. It's They have they do investments for Alberta. They have their own brokerage firm. They have their own bank, and ATB put on a nice conference, inviting a lot of Canadian energy and infrastructure companies. So, Ernest, you got some points to talk about. Go ahead.
So, first of all, let's give a shout out to Joel Meloff, who works at ATB and is our friend who invited us to the conference.
That's right. If for all your institutional trading needs, check out Joel Meloff at ATB. Lovely guy.
Yep. But so he invited us to this conference, and it's a 2-day event. The first day was about the energy industry, and the second day was more diversified. So like some industrial companies, some commercial companies, and these are more smaller type companies. It's not like Royal Bank or Loblaws.
Yeah.
It's small to mid cap companies that you may or may not have heard of in your life. Mm-hmm. And so the reason that I attend these things is that, number one, it's a good chance to meet CEOs, meet the management of these companies, listen to the stories of companies that maybe you've never even heard of in your lifetime. And then secondly, just observe the kind of the current vibe of the market. What are people thinking about today? What are people are people generally nervous? Are people like generally like optimistic about things?
And it's an interesting time to have this conference because today's January 15th. January 20th, Donald Trump is inaugurated as president. He's threatened, promised tariffs against Canada. No one knows for certain if it's going to be incremental tariffs, if it's going to be a flat tariff. He's promised he's going to apply tariffs on all Canadian goods, including oil and gas, which we've talked about here on this podcast many times. Our stance is that's absolutely ludicrous. But it's an interesting time because, Ernest, oil and gas prices have been firming up lately, right? Oil is at a multi-month high, $78 US crude. Natural gas over $4, highest price in months. And Canadian energy stocks are lagging because of the worry, the concern that there's going to be holdbacks and tariffs on their exports to the US. And that's a good reason for those stock prices to not do well. But if that reverses, they're certainly not taking advantage of the fact that the energy prices are so strong today. So,
well, with regards to natural gas, like you need to make money to have tariffs put on something.
Yes.
And so like it's not really a concern for Canadian natural gas overall, because it's like it's basically money. Free already.
Yes. That's a good point.
Yep. Yeah. So for that sport section of the market specifically, there's no concerns.
Yeah. It's the Canadian oil. It's the oil sands stuff.
But the way these conferences are set up is that they have they'll have like there's a big conference room where there's like a featured speaker or a panel, and then they'll talk about a specific topic, or you can do a 1-on-1 or a 2-on-1 or 3-on-1 meeting with the management.
Yeah.
So big picture, the energy industry, I think, is still like it was the day one was less busy than day two.
Okay.
I think for whatever reason, investors are still not as interested in the energy market as they are from like the rest of the economy.
Yeah, it wasn't a good year for Canadian energy stocks in 2024. I don't think 2023 was a good year really either for energy stocks. Energy stocks really took off in 21 and 2022 after a disastrous 2020, right? And so they've kind of gone nowhere. I'm looking at, some Canadian energy stocks. Some of them have, you've really just gotten the dividend over 15, 16 years, right?
Yeah.
It's been a tough slog.
Yep. And so the first day, I think the big story for Canadian oil and gas is that natural gas is here to stay. It is if you look at the demands for natural gas, both from LNG projects in Canada and the US, as well as demands from data centers for electricity and all those kinds of things, you're going to need natural gas to power this, right? Like there's just not enough renewables being built, and more importantly, like
definitely not
to meet the base load requirements for the electricity that's required for these things.
Yeah. So wind and solar and hydro, all are competing energy alternatives, but not always realistic to provide 24/7 reliable base load, especially for a data center or electricity grid, right? You can't have rolling brownouts and dependent on a energy supply that's not reliant.
And maybe it's just that the Canadian energy space has been suffering for such a long time that even though it looks like things are going to be better in the fairly near future, it still feels like everybody's a little bit cautious that things are actually getting better. At least that was the tone that I got.
Yeah. So essentially you're saying coming out of the great financial crisis, energy stocks have just been destroyed, right? There was a little run up, but
especially since 2015.
2015. That's what I was trying to grab at. It's 2015, and there was a little renaissance, I guess, after COVID, after the pandemic. and then kind of more back to normal. So people, even though energy, there's been more discipline with energy companies, their balance sheets are way better. Now there's concerns, of course, of alternatives and electric cars, and that oil and gas has peaked.
And I think Tourmaline Oil.
Yeah.
So we've talked about it on the podcast before. It's the largest natural gas company in Canada by quite some fraction.
Okay.
They did a pretty good job of kind of speaking for the whole industry to talk about why the Canadian natural gas industry is going to be great in the next little while. Okay. And I mean, like, to some extent, you're kind of asking a barber for a haircut.
Yeah, well, I mean, we're in the storytelling business,
right,
and so are the CEOs, but
right,
for sure.
But I think that the main idea is that even if you look at all of the expected growth in natural gas supply from Western Canada or from the Permian Basin in the U.S., it's still not going to be enough to meet the expected demands from data centers and from LNG exports. And even globally, if you look at the amount of LNG projects that are in place, it's still like it's expected to be a balanced market because the demand from China and Japan and South Korea and these places is actually real. Like they actually need more natural gas. Even
if weather isn't a big issue, in Canada we're actually having a cold spell here, but the last 2 years have been quite warm and a lot of
yeah. So that's kind of like a high level picture of where we are, and I also had the other reason why I think it makes sense to meet company management is that it's less about. I think some people go into these meetings and they're trying to get like inside information. Yeah. They're like, oh, like, do you think you're gonna be like, how close do you think you're gonna be to beating your estimates for the next quarter
for production growth or what have you? Yeah, or you're gonna keep your costs lower,
right? And I think for me, we're long-term investors.
Yeah.
My approach is more to just get a sense of how the CEO or the management team likes to think about things. Like, are they primarily numbers driven in how they approach the business? Like, are they familiar with the ins and outs and the dynamics of what's going on? Like, and can they talk about these things fluently, right? Like, do they have a clear vision for what they're doing in their business?
Yep.
And are they able to articulate it clearly? And those are the kind of things that I really focus on during these meetings. And so for me, the highlight of the meeting was a one-on-one meeting with Mike Rose, the CEO of Tourmaline Oil. And
it's for Ernest, this is like meeting,
it's like the Michael Jordan of gas.
Yeah, the Wayne Gretzky of hockey, the Michael Jordan of gas. Yeah, I mean, it's just if you're nerds like us who love all-star CEOs, this guy's in the top 20.
And when you meet Mike Rose, like he's rattling off numbers about like the recovery factor for like the Haynesville Basin. So he knows his you know what, right?
Yeah,
it's not just something that he put onto an investor presentation deck.
Yeah,
like these are numbers that he clearly has. He's clearly a very numbers driven person, and I think that's what you want to see if you're.
His background is a geologist, engineer. Yes.
Yeah. His background, he is a geologist, so he's like, you can tell he understands like the rocks that are there, and it's not just a businessman who's like, oh, I want to make some money in gas, right? So I think that's generally how I like to approach these events.
Yeah, excellent.
And so the second day was I met a few companies. Some of them we own, some of them we don't, but I think the other thing that's interesting is that you can read the headlines in the newspaper about things like tariffs, but then when you actually talk to companies that are on the ground and dealing with these issues on like an actual basis, I think it gives you a bit of a different perspective around how a 25% tariff would impact things day to day, right? So for example, I met a company called New Flyer, NFI Inc., right? They are one of the largest makers of buses in North America. And they said that
School buses, coach buses.
They'll make school buses.
Yeah.
They make public transit buses.
Got it.
And they make coaches.
Okay.
And so what they said is that, like to the extent that there is a 25% tariff on coaches, on Canadian goods,
Yeah.
the coach market would fall to zero, essentially. Like there's just no way that there's no coach manufacturing facilities for anyone in the US. And it's not something that the market is going to be able to just figure out.
So if 25% tariff was applied to their bus and they were selling it to a U.S. Municipality, like who's going to pay the 25% extra? Nobody.
No, so it's different for coaches and it's different for buses.
Got it.
So for the transit buses, these are generally long-term contracts that are made in the U.S. because the way transit funding works is that they get funding from the city or from the government, which says the bus has to be made in the U.S.
Got it.
For you to be qualified for this funding.
Yeah.
And so there is they have to import some parts but then the contracts typically allow them to raise prices for these things.
Makes sense. Okay.
For coaches, it's totally different, right? You're selling to private operators. It's not a contract. It's just like, give me 3 buses or whatever. Yeah. And there's just no way that the industry is going to be able to figure
new
this
buses.
out.
Yeah. Okay.
I think New Flyer will just tell their customers, look, we have to raise prices by 25%.
Yeah.
And the customers will say, no, I can't afford that.
Yeah.
And that's that, right? So coach demand is probably going to dry up.
Fascinating.
Or possibly even shift to
horse and buggy.
So the other part is that some of the competitors make in places like, I think it was Poland or somewhere in Eastern Europe, and where there's not going to be a tariff, right? So New Flyer said, maybe we'll shift our production to Poland.
Yeah.
Right?
Exactly. So there's always you can always figure stuff out.
Yeah. So but the point is extremely messy in practice.
Yeah.
And we'll just have to see how it plays out.
Yeah. It's I don't envy any manufacturer, right? Canadian or non-US manufacturer right now to figure this stuff out. It's very complicated. So I think you laid out some great takeaways from the conference. Natural, although take it with a grain of salt, right? In the commodity business, they'll always tell you the future is brighter than it is today.
Well, Mike Rose even admitted that in the last 12 years, 10 of them have been below expectations.
Yes. So maybe this is the turning point, but it does seem like everything is going positive for natural gas. And we'll see how it plays out. Ernest, we're playing natural gas. We're owners of Tourmaline. We're owners of Canadian Natural Resources.
Yep.
And some other infrastructure plays that help shift gas and infrastructure across North America. It's beneficial. We'll see if if Trump backs down on some of those concerns. Anything else you want to add to today's conversation?
No, that's just what we do all on a daily basis.
Beautiful. Well, thank you for joining us today, and we'll see you back here real soon. This podcast is for informational purposes only, and any forecasts on the economy, markets, or individual securities should not be viewed as investment advice, a recommendation or an offer or solicitation to buy or sell any securities. Clients of Baskin Wealth Management and the speakers on this podcast may own shares of the companies discussed. Information on this podcast is current as of the time of production and is subject to change. If you have any questions or would like to subscribe to these podcasts, visit our website at baskinwealth.com.